We've got a notable call on the broader stock market. With the S&P 500 already up more than 20% this year, next guest sees bullish momentum continuing over the next couple of years, with the possibility of the index reaching 5,400 by the end of next year, 6,000 possibly by the end of 2025. Those two moves would represent upside of 16 and 29% respectively. Ed Yardeni is the president of Yardeni Research. He has been tracking the market for more than 4 decades. Ed, good morning. Thanks for joining us as always.
Morning. Thank you very much.
What's behind your thinking right now on where stocks go from here?
Well, in the short term, I think what everybody seems to be missing is that the U.S. doesn't have to have a recession to bring inflation down. We've proven that for the past 2 years. Inflation's come down substantially since last summer without a recession. And the reason for that is that we live in a global economy. And the reality is the Chinese and the Europeans have done us a great favor. China is in a property market depression, worse than what we had during the great financial crisis in the United States, and worse than what the Japanese had in the late 1980s. Meanwhile, Europe is in a shallow recession. And as a result of all that, China's exporting deflation in goods to the rest of the world. And meanwhile, rent inflation is stickier, but it's coming down in the U.S. So in the short term, that's helped to bring bond yields down, even though we have a huge deficit problem. And meanwhile, earnings just hit an all-time record high for the S&P 500 during the third quarter. Looking beyond that, I think that productivity is making a comeback. And I think productivity is making a comeback because we've got a very serious economic problem, and that is a shortage of skilled labor. But we have technologies that can augment labor, make them more skilled. And I think productivity is going to be the heart of the story for the remaining of the decade. So to conclude, I think we may very well be looking back at the current decade and calling it the roaring 2020s.
All right. That's an interesting setup. You know, the other thing we've been watching recently is the bond market. And certainly during some of the choppier periods this year for the stock market, we were seeing those treasury yields continuing to climb. For those who don't know, you quite literally coined the term bond vigilante. I believe back in 1983. Can you tell us your interpretation of what the bond world has been doing of late?
Well, I think the bond vigilantes did saddle up and start riding high during the summer from August 1st actually through November 1st. And they made it very clear that they were very concerned about the deficit and debt. And then the question is, so where'd they go? Why are they suddenly not out there? And I think the answer is the bond vigilantes aren't the only players in the bond market. You know, they say don't fight the Fed, but on November 1st, it was don't fight Janet Yellen, the Secretary of the Treasury, because she basically said, well, if the bond vigilantes aren't happy with all the supply of bonds and notes, we'll cut back on them and issue more bills. And that helped quite a bit. The other thing is there are a lot of long investors who desperately need to be in the market at a good yield. And 4% is a good yield, but they held back because there was all this talk about going to 5%. At 5%, we found a lot of buyers, especially since the inflation news continues to confirm that inflation is moderating. And also on November 1st, by the way, Fed Chairman Powell basically said, we're there, we're where we want to be in terms of restrictiveness, implying that the Fed wasn't going to be raising interest rates any further.
You know, Ed, we like to have lots of views just to give people a sample of different market thinking. I want to circle back on something that I believe we talked about earlier this year, which is the technology sector. Now, for those who have been cautious on the equity market, oftentimes we've seen them point to the fact that you have a select group of stocks, let's call them the Magnificent Seven for the S&P 500, that have had such a big rally that if you excluded them, you'd be talking about weaker performance, and if they were to lose investor sentiment or whatever, that would also be a headwind for the S&P 500. But I remember you talking about whether or not it matters that a select group of stocks have a large influence within the index. What is your current thinking?
Well, my current thinking is basically the same as it's been for the past year or so, as the bears have been growling that it's really not a bull market because only 7 stocks are leading the way and everything else is kind of flattish, I've been saying there's no particular reason why it couldn't actually broaden out at some point. Why does it have to end badly? Why can't it end well with the market recognizing that we're not going to have a recession after all? Inflation's moderating. The Fed isn't raising interest rates anymore. Why couldn't it broaden? And I think that's exactly what's happening right now.
Does that mean then, if, because I mentioned even 2 years out, you think that it's not inconceivable that the S&P 500 gets to 6,000 by the end of 2025?
Yeah.
Is that based on the idea of a broader equity rally over the next couple of years?
Yes, it is. It's based on a broader equity rally. It's also based on the conclusion that these 7 stocks aren't going to go away. They're going to continue to account for at least 25% of the market cap of the S&P 500, if not 30%, and they have a high valuation multiple because they deserve it.